Have you ever wondered why getting a mortgage feels so complicated? Why the bank seems to have so much power, and why your parents or grandparents talk about a time when things were simpler? The answer lies in a story most people have never heard, a story of greed, deregulation, and a financial collapse so massive it was hidden in plain sight, but its aftershocks reshaped the American dream and how you buy a home forever. This is the story of the savings and loan crisis. To understand this crisis, we have to go back to a quieter time. Imagine your local friendly neighborhood bank. For decades, these weren't giant, faceless corporations. They were savings and loan associations, or S&Ls. Their mission was simple and noble. They took in savings from local people, your neighbors, your family, and used that money to give out mortgages to other local people who wanted to buy homes. They were the bedrock of community homeownership. They operated under strict rules, paying a set interest rate on savings and charging a slightly higher fixed rate on mortgages. It was a stable, predictable, and, frankly, a bit boring system. But it worked. It built neighborhoods, it fostered communities, and it made the dream of owning a home accessible to millions of Americans. But in the late 1970s, the world started to change, and this quiet, stable system was about to be turned into a casino. The villain of our story isn't a person, but a number: inflation. In the late 70s and early 80s, inflation in the United States went completely haywire, skyrocketing into the double digits. Suddenly, the fixed interest rates S&Ls were legally allowed to offer on savings accounts, around 5.5%, were a joke. Why would anyone keep their money in an S&L when they could put it in a new thing called a money market fund and earn 10%, 12%, or even more? People began pulling their money out of S&Ls in droves. This was a slow-motion bank run. At the same time, the S&Ls were stuck. They had billions of dollars locked up in old, long-term mortgages, paying them back at laughably low rates of 6% or 7%. So their cost of getting money was going up, but their income from old loans was fixed. They were bleeding money, fast. The entire industry, the foundation of American homeownership, was teetering on the brink of absolute collapse. Washington had to do something. But what they did next was like trying to put out a fire with a barrel of gasoline. In a desperate attempt to save the S&Ls, Congress passed new laws in the early 1980s. The idea was to unshackle them. These new rules did two main things. First, they allowed S&Ls to offer much higher competitive interest rates to attract depositors back. Second, and this is the crucial part, they allowed S&Ls to invest in things other than boring, safe home mortgages. They could now pour your savings into much riskier ventures: speculative real estate developments, junk bonds, commercial projects, you name it. The guardrails were gone. At the same time, another fateful decision was made. Federal deposit insurance was increased from $40,000 to $100,000 per account. Think about what that combination created. You had S&L operators who could now gamble with other people's money. If their risky bets paid off, they got rich. If their bets failed, no problem. The American taxpayer would cover the losses up to $100,000 per depositor. It was a system with all of the reward and none of the risk for the bankers. A new breed of aggressive, risk-taking executives flooded the industry, pushing the old conservative managers aside. The quiet, community-focused S&Ls were about to become ground zero for a frenzy of speculation and fraud. The party had begun. All over the country, especially in states like Texas and California, S&Ls transformed overnight. Money poured in from depositors chasing high interest rates, and it poured right back out into incredibly risky projects. Imagine sprawling, empty office parks built in the middle of nowhere. Half-finished luxury condo developments with no buyers. Wind farms that never generated a single watt of electricity. It was a gold rush fueled by federally insured deposits. S&L executives were living like rock stars, buying private jets, yachts, and funding lavish parties, all with money that was supposed to be for your neighbor's mortgage. This was called an land flipping, where a piece of property would be sold back and forth between friendly developers, each time at a higher, artificially inflated price, with the S&L financing every fraudulent transaction. The books looked great, profits seemed to be soaring, but it was all a house of cards. The assets on their balance sheets weren't worth a fraction of what they claimed, and because regulatory oversight had been slashed, there were very few watchdogs to call them out. The fuse was lit and the bomb was getting bigger every single day. By the mid-1980s, the house of cards began to wobble. The commercial real estate market, bloated by all this speculative investment, started to crash. Oil prices fell, cratering the economies of states like Texas and Louisiana, where much of the fraud was centered. Suddenly, those risky loans weren't getting paid back. The empty office buildings stayed empty. The luxury condos remained vacant. The S&Ls that had gambled the most aggressively started to fail, one by one. But this is where the story gets even darker. Instead of shutting them down, regulators under political pressure practiced what's called forbearance. They basically looked the other way, hoping the problem would fix itself. They allowed these insolvent, zombie S&Ls to keep operating. And what does a desperate, broke gambler do? They double down. These zombie S&Ls offered even higher interest rates to attract more deposits, and then plowed that new money into even riskier bets, trying for a miracle. They were digging the hole deeper and deeper, and every shovel of dirt was another $1 billion added to the taxpayer's future bill. Finally, in the late 1980s, the whole rotten structure came crashing down. The scale of the collapse was staggering. Over 1,000 savings and loans, a third of the entire industry, failed. The final bill for the taxpayer bailout was astronomical, costing an estimated $160 billion. That's over $350 billion in today's money. It was, at the time, the most expensive financial bailout in American history. Hundreds of bankers and executives were prosecuted, with some, like the infamous Charles Keating of Lincoln Savings and Loan, becoming household names and symbols of the era's greed. Keating's failure alone cost taxpayers over $3 billion. But the real legacy wasn't just the financial cost. The crisis fundamentally broke the old model of community banking. So, why does this 40-year-old crisis still matter to you, right now, as you think about buying a house? Because everything changed. The surviving S&Ls were either bought out or transformed into commercial banks. The specialized local mortgage lender largely disappeared. In their place rose the giant national and international megabanks we know today. Mortgages were no longer simple loans held by your local S&L. They became complex financial products, bundled together with thousands of other mortgages from all over the country into something called mortgage-backed securities. These were then sliced up and sold to investors all around the world. Your personal connection to your lender was severed. You became a line item in a massive, anonymous pool of debt. This new system, born from the ashes of the S&L crisis, prized volume and speed over community and stability. It created the complex, often impersonal, and fee-laden mortgage industry we navigate today. And this very system of bundling and selling mortgages, perfected after the S&L crisis, would become the core component of the next, even bigger financial meltdown, the 2008 global financial crisis. The savings and loan crisis is a powerful, cautionary tale. It's a story about what happens when deregulation goes too far, when oversight is weak, and when the link between risk and reward is broken. It shows how decisions made in Washington can fundamentally alter the landscape of Main Street, changing the very nature of how we achieve core parts of the American dream, like owning a home. It's the hidden chapter in our recent financial history that explains so much about the world we live in now. The names and the numbers may have changed, but the fundamental lessons about greed, risk, and responsibility are more relevant than ever. Thank you so much for watching. This is a complex piece of history, and I hope we made it a bit clearer. If you found this interesting, please hit that like button and consider subscribing for more deep dives into the stories that shape our world. We'd love to hear your thoughts in the comments below. See you in the next video.